But here are three things that you need to know as we kick off today's show on this Monday. Markets pricing in another rate hike announcement from the Federal Reserve this week. Last week's hotter than expected inflation data, along with Powell's pledge to aggressively fight inflation, means another 75 basis point rate hike is likely. This as multiple central banks around the world, including the Bank of England and the Bank of Japan, they are expected to announce market-moving decisions. And that goes to show this broader global picture that the Fed was trying to lay out. Fed Chair Jerome Powell alluded to within Jackson Hole at his speech there in the symposium, but particularly as you look across where in the different parts of the world where you're going to see this economic pullback also try to be countered with some type of policy decision making from each of the central banks. The Fed just trying to kind of lay out the pathway for what their equation is, what they actually have to combat going forward from here. And that means that they are going to be a little bit more aggressive, as inflation clearly has not peaked yet, even though it is still kind of simmering, hopefully, to this halt, at least on any upward movement from this point. But that's really causing a lot of banks to really get ahead of what could take place with regard to any type of recession that would be felt here in the U.S. And try to predict how long or protracted that would be, or if it would be brief, and to what extent that would impact everything from the businesses that they cover all the way down to the everyday consumer.
And we very acutely saw this grappling happening last week after we got the CPI print that sent stocks down sharply, and then the turmoil that ensued for the rest of the week, too. It wasn't just that one-day drop, right? We saw some further declines there. So all of that contributing to this negative view. I should correct myself from a few moments ago. 10-year yield at 3.5%, the highest since 2011.
Okay.
So, but still,
yeah,
that's a long time.
Right.
Right, as we see this pricing in process for these higher yields. And as all of this is happening, we continue to see strategists try and figure out what is priced in, where is an appropriate level for stocks. One of those is Lori Calvasina over at RBC, who said valuations, she said in a note this morning, valuations are actually starting to look reasonable again for the S&P 500. There you see the forward price to earnings ratio for the S&P 500. And she said, given the price action we've seen lately, given her outlook for earnings here, there's still a lot of uncertainty about the earnings outlook, she says, but we suspect that investors will not allow stocks to stay too cheap for too long, given the view, which is pretty widespread here, that if and when there is this economic downturn, that it'll be relatively minor, relatively shallow, won't be too severe. And so people are going to want to be getting ahead of that. Right.
People are going to be wanting to get ahead of it. But for the low-income households that are feeling this the most right now, it's going to be a larger question of when they're able to, and for the parts of the economy that are already starting to feel the grips of an economic downturn because of whether things are costing them more and then negating any type of wage increases that they have been able to take on, that's going to be a much larger kind of impact to the lower income parts of the U.S. economy. But then you think about where some of the middle class and even some of the upper class has curbed their spending. Of course, there's still the companies that we track where in the retail segment, at least, you see that the super luxury goods, they're still being bought.
Yeah.
And so that gives you kind of one end of the scale there. But on the other end, you still have the middle income and middle class parts of the society that are going to be looking across, okay, where are they curbing spending for the household? Not just going into the school year, because we've already got that spending accounted for. Now it's, okay, if we look out to the travel season, what that looks like for the holidays. If you look at household spending and what type of cash they're spending, if they're spending cash versus just saying, we just need to put it on credit for right now until we can pay it off later on. That's going to be a considerable consideration that they have to work through. And that could have a much longer standing implication as well.
Right. And of course, all of this we're hearing from companies. They're stacking up, right? We have the retailers, as you talked about, FedEx last week, but also industrial companies, Nucor, Arconic, some of those that were giving warnings as well. So maybe investors bracing themselves a little bit to see who could be next on that list.